Hello friends, welcome to a live lecture series on financial management. In the previous lecture of mine, I told you about the basics of Treasury Management and Control, that is also known as cash management. So this is going to be the part 2 of Treasury Management and Control, or you can say the cash management part 2. In this lecture of mine today I'll be telling you how to solve a practical problem of cash budget, how to prepare a cash budget for a given organization. It can be a monthly budget, it can be a daily budget, it can be annual budget. So depending on the type of firm we are going to deal with, I'll be telling you how to prepare a cash budget. In the previous lecture of mine, I told you about a very small numerical where the information for 4 months were given and we were supposed to prepare the cash budget. Just to recapitulate what was there into the question, I'll quickly run through the question and then we'll solve this particular question. In this particular question, the question was going like this, that the sales forecast, the forecast for Bhanu Limited was given like this for 4 months: sales, raw material, manufacturing expenses, loan installment. The question was reporting you that all sales are made on credit basis, 2/3 of debtors are collected in the same month and balance in the next month. There are no expected bad debts. The debtors on January 1, 2019 were rupees 30,000. The question says that minimum cash balance, this is what we have to keep in our mind, that the minimum cash balance the firm must have is estimated to be rupees 5,000. However, the cash balance on January 1 was rupees 6,500 and borrowings can be made in multiple of rupees 100 only. We have to prepare cash budget for 4 months, but the question says that we have to ignore interest on borrowings. So let's solve this particular question. The cash budget, when we'll start, just like I told you before, that we have to start with the opening balance which is given in the question. In this question, from the information section, we'll be finding the opening balance of cash. So in the month of January, I have written here that opening balance of cash is rupees 6,500. Now we'll be categorizing all the transactions into two categories. One is the inflow, the other is outflow. Under inflow category, we have two subcategories. One is debtors, that is from previous month, and second is collection from debtors in the current month. The question says that you'll be the entire sale is made on credit and 2/3 of sale is received in the same month. So for the first month in the January, the sales was of 75,000 rupees. So 2/3 of it comes to be rupees 50,000. So under the category of collection from debtors in the current month, I have written rupees 50,000 here, and remaining 25,000 rupees, it will go to the collection of February, which will be showing under the same head that inflows, debtors from previous month, collection. So in the month of February, the sale of January becomes the previous month sale. So this 25,000 rupees is posted there. So in this way we have dealt with this 75,000 rupees, the first amount. The same process we have to follow for the subsequent months also, like 2/3 of sales for February becomes rupees 70,000 and 1/3 becomes 35,000 rupees. So 2/3 we are writing here, posting here in the month of February 70,000 rupees under the current month, and for March, February becomes the previous month and we have shown 35,000 rupees there. The same process we have to follow for the March also. 1,20,000 rupees is shown here in the month of March, and in April the 1/3 goes, that is rupees 60,000, because the total sales reported for the month of March was rupees 80,000. The same will be the case of April. Whatever sales of April is given, the 70,000 rupees we have shown, because 1,05,000 rupees was the total sales of April. So 70,000 rupees we have written here. For the next month we have not shown here because we are supposed to prepare the cash budget for 4 months only. So after posting this particular collection from debtors, we have to understand for the month of January, under the previous month there is no amount given, but the debtors balance of rupees 30,000 was given. So the same is posted here in the month of January, rupees 30,000. Under inflows, debtors from previous month, we have written rupees 30,000. So in this way we have posted all the cash collections, either it is from credit or from cash. Here in this question there is no cash sale, all is credit. So we have posted all the collections from debtors. Once we have posted, we can aggregate them. When we add, for instance for the month of January, when we are aggregating rupees 6,500, 30,000 and 50,000, it becomes 86,500. So this 50, 30 and 6,500, it becomes rupees 86,500. This is my total of inflow, which I'll be categorizing as A, because the outflow will be B as per the format which I have shown you in the previous lecture of mine. And in this way we have to aggregate the collections for every month, and we have to find out the total of inflows. Once we aggregate, the total of inflow is known to us. After this, the next step is to take all the outflow items. The first item in this category was raw material, rupees 70,000 given for January, manufacturing expenses 10,000 given for January, loan installment of 1,000 rupees given for January. When we aggregate them, it becomes rupees 81,000. 86,500 was my inflow, total of inflow. Outflow is 81,000. So we got 5,500 rupees as my closing balance. So in this year, there is no borrowing which is required. The same process we have to follow for every month, but we have to remember, my dear students, that there has to be a minimum balance of rupees 5,000. Every month you have to maintain a minimum balance of 5,000 rupees. So in case there is some shortfall, we'll have to take loan, and the question has suggested us that borrowings can be made in multiples of rupees 100. When we followed the same process for the month of February, what is happening? There is a deficit of rupees 30,500. Our outflows actually superseded the inflow. They are greater than the inflow. So there is a deficit of rupees 30,500. At times students thinks that we have to take a loan of rupees 30,500. Answer is no. You'll have to take a loan for that amount which is not only able to complete your requirement of this deficit of 30,500, but also the minimum balance of rupees 5,000. So we have to maintain a minimum balance of rupees 5,000 rupees, 30,500 rupees we have a deficit. So we'll be taking a loan of rupees 35,500, which we have shown as borrowings. 35,500 for the month of February we are going to borrow. After borrowing this 35,500 rupees, our modified cash balance becomes rupees 5,000. Now our closing balance was actually 30,500 negative, but since we have taken loan of rupees 35,500, our modified cash balance becomes 5,000 rupees, which is actually the requirement of the firm, that you have to maintain a minimum cash balance of rupees 5,000, and the same we have executed. In this way, for the month of March, the opening balance becomes rupees 5,000, and after we aggregate the inflow and outflow in the month of March, what happens? We have a surplus here. We have a surplus of rupees 30,000, and as a rational fund manager, it is our duty, it is our utmost duty to ensure that loan is paid within the possible minimum time. So in next very month, we are going to repay this particular loan to the possible extent, but we have to understand that the minimum cash balance requirement is of 5,000 rupees. So 30,000 rupees is our closing cash balance in the month of March, and we took loan of 35,500. So what we'll do, we'll repay rupees 25,000 rupees, because this is the maximum amount which we can repay after maintaining a cash balance of rupees 5,000. So in the month of March also, we got a modified cash balance of rupees 5,000. Once it is done, we'll follow the same process in the month of April also. In the month of April, again we got a surplus of rupees 13,000, and after maintaining a cash balance of 5,000 rupees, we can repay rupees 8,000. So in this way, we have understood how to borrow this particular amount whenever there is a requirement, and how to repay this particular amount. In this particular question, the rate of interest was not given, so we will not consider that, because the question says that we have to ignore the interest on borrowings, and the same we have did. So we have to actually understand that once we are taking loan, the loan is always taken at the end of the month. So on month wise, suppose if there is a provision of interest, we will be paying interest onto that. That will be dealing with that I'll be telling you with the example of some other numerical, or in the same numerical I'll be telling you how to deal with this particular component of interest. But here what we have understood, how to deal with the borrowings and repayments. When borrowings is done, the amount is shown as positive. When the repayments are done, the amount is shown as negative. So if you look at the total budget at a glance, you will find the budget like this, that for the month of January there is no borrowing required. For the month of February, the borrowing of 35,500 is required. For the month of March, there is a repayment of rupees 25,000 rupees, and in the month of April, again there is a repayment of rupees 8,000. So in this way, with the help of given information we have understood how to prepare cash budget. This was the simplest question of cash budget, where the collection from debtors is given as per the condition we have implemented, and there is a condition of minimum balance which we have very well implemented to prepare our cash budget. So in this way, we can have a forecast for every month, say for January, February, March and April, that this will be our requirement. And as I told you at the very outset, the benefit of this particular forecasting is that you can have some arrangement with your banker in advance, that in this month I am going to have a deficit of cash, so I'll actually be seeking loan, and that loan is always or you can say readily available to you available to you, and you can make use of that particular loan. So this is the way we have to prepare the cash budget. Now suppose if in the same question the rate of interest on borrowings would have been given, and the language could have been the interest on borrowings will be 10%. Remember, when you are solving this type of question, you have to understand whether the rate is given 10% per annum or it is simply 10%. In this question, it is written only 10%, so we will be charging 10% interest on whatever amount we borrow for whatever period. Here the question is saying flat 10%, so we will have to pay interest on that particular borrowings. And the question says that borrowings and payments can be made in the multiple of 100 only, which means if you have to borrow in multiple of 100 only, and when you have to repay in multiple of 100 only. So let's prepare the cash budget with this information. In the same question, if we include the component of interest, what happens? Let's see. In the same cash budget, what is happening in the month of February? If you look, the loan of rupees 35,000 was actually taken. 35,500 was taken. This is clear to you? So what is our duty? The loan was taken in the month of February at the end. So on this 35,500 we have to pay interest. So under outflows, if you look at the arrow, we have paid interest at the rate of 10%, that is 3,550. This interest of 3550 is actually computed on the loan which we have taken, that is 35,500. So what will actually change? The change will be in the month of March. In the subsequent month, after the borrowing is done, whatever repayment you do, before that repayment amount, you have to charge interest on the loan which you have taken, because the interest is something which you have to pay. Otherwise, you'll have to, you'll get chargeable on interest as well. Your interest will be charged on the interest also. Banker will actually club your amount of interest into your principal amount of loan. So to avoid that, what we have done, we have shown under the cash outflow the interest on borrowings at the rate of 10%. For first 2 months it is nil because there was no borrowing. In the month of March we are going to pay because the borrowing was the loan was taken in the month of February for 35,500 and we have paid interest onto that. After paying this interest, what will be the outcome? The outcome will be that our cash balance will actually get reduced with this amount. And that is why we are not going to repay that much of amount which we were paying without interest. Here it will actually be 21,400. Earlier it was more than that because the interest was not paid. So the repayment amount here becomes rupees 21,400. And after paying this particular amount, whatever is the remaining balance, for that will be charging interest in the next month. If you look at the next month, interest, the interest is actually 1410, right? So in this way we have understood that 1410 of interest is actually paid in this particular question. So in this way, my dear students, we have understood how to prepare a cash budget when there is a condition of interest on borrowings. Interest on borrowings is given. We have to understand that whenever we are paying interest on that particular borrowing, that interest is going to be paid, and that interest is supposed to be paid in the subsequent month. So we have understood how to deal with this particular situation when the interest on borrowing is given. So this was a simple question of cash budget. Let's increase our understanding of cash budget with another example. Let's have a look at problem number 2. Suppose there is a sales forecast given for first 5 months for a coming year for a particular company. Month-wise sales forecast is given for April, May, June, July and August. The sales forecast goes like rupees 40,000, 45,000, 55,000, 60,000 and 50,000. The question informs you that debtors and creditors balance at the beginning of the year are rupees 30,000 and 14,000 respectively. So debtors balance was rupees 30,000, which means we are supposed to receive rupees 30,000 in this month as per the condition of debtors, and 14,000 is to be paid to creditors as per the stipulated condition. The balance of other relevant assets and liabilities which are given: cash balance rupees 7,500, stock rupees 51,000, and accrued sales commission rupees 3,500. So accrued sales commission is also given 3,500. 40% sales are on cash basis. Credit sales are collected in the month following the sale. So 40% of sale is actually made on cash basis, remaining on credit, and the credit sales are collected in the month following the sale, which means in the subsequent month you will be collecting the sales. Cost of sales here is 60% of sales. This information is very important. Cost of goods sold is 60% of sales. The only other variable cost is 5% commission to sales agent, and this commission is paid a month after it is earned. Further, the question is informing stock is kept equal to the sales requirement for the next 2 months budgeted sales, and trade creditors are paid in the following month after purchases. Fixed cost are rupees 5,000, which includes rupees 2,000 depreciation. Remember, 2,000 rupees is actually a non-cash item. This will not consider, will only consider fixed cost of rupees 3,000 because we are preparing cash budget, not the credit budget. Now we are required to prepare a cash budget for the month of April, May and June respectively. My dear students, when you look at this particular question, the information which is missing is the purchases. There is no mention of purchase of raw material. So we'll have to understand in this particular question, we'll first calculate the amount of purchases. In this question, sales is given, sales forecast are given. Opening stock, for that we are provided with the value of opening stock. For closing stock, the question is telling you that you have to maintain a closing stock which is equal to the 2-month sales requirement. So there is a hint for closing stock also. There is a hint for some expenses, that there are no other expenses, only variable cost is salesman's commission. So we have to understand tactfully that how to calculate the amount of purchase, because unless we calculate the amount of purchase, we can't understand that what are my trade creditors, and we cannot apply that particular policy of making payment to creditors as per the given condition in the question. For this, if you get reminded of trading account, traditional T-shape trading account, opening stock and purchase and expenses were shown on the debit side and closing stock sales were shown on the credit side. So in this question, sales is known to us, closing stock is known to us, opening stock is known to us, but purchase is missing. So how will be calculating the amount of purchase as a balancing figure? We'll take up sales, we'll take up closing stock, and then we'll deduct opening stock out of it to arrive at the amount of purchases, so that we can decide that what is the amount which is to be paid to the creditors. So let us solve this particular question and let's start our journey with the calculation of purchases. If you look at the sales of the month of April, it is given for rupees 40,000, for May it is 45,000, for June it is 55,000. Cost of goods sold given in the question is 60%, so we will be computing 60% of it. For the month of April it becomes rupees 24,000, for May it is 27,000 and June it is 33,000. If you calculate 60% of it, the amount comes like this. Now the question comes, why are we calculating cost of sales? It is very clear, since we have to calculate the amount of purchases, purchase is always at cost, inventory will also be valued at cost, so we have to take cost of goods sold only, will not be taking gross profit, will not take the margin component into our sales. So the first step is, in place of sales we will be taking cost of sales, which we have written here. The next step is, what is the closing stock? The question says the required closing stock is actually at cost we have to take. It says that the closing stock is supposed to be kept which is equal to the 2-month sales requirements. If you look at the month of April, for April, May and June sales are the relevant value. In the month of May, the sales is 45,000, in the month of June it is 55,000. If you club it, it becomes rupees 1 lakh. But I have written here required closing stock at cost, that is 60,000. Why so? Because 1 lakh rupees is my selling price, the total selling price, which also includes the gross profit margin. So I have eliminated the component of gross profit margin and the sales at cost is written, that is rupees 60,000. The same process I have to follow for the month of May and June. In the month of May, I'll be taking the sales of June and July. In the month of June, the sales was 55,000. In the month of July, it is 60,000. When you club it, it becomes 1,15,000. 60% of it becomes 69,000. The same process we have to follow. So once we have taken cost of goods sold and closing stock at cost, we can club them, cost of goods sold at closing stock, as per the formula which I told you at the very outset, and the same process we have to follow for subsequent month also. So in the first month, cost of goods sold plus closing stock becomes 84,000, in the second month it becomes 96,000, and in third month it becomes 99,000. Now we have to deduct opening stock. Here my students are asking me, sir, opening stock is given for first month only. Question reports opening stock is 51,000. What about the closing stock of May and June? It is very much there. When the closing stock is given for the month of April, which we have just calculated, the closing stock of April will become the opening stock of May, and the closing stock of May will become the opening stock of June, which is being shown by this particular arrow in blue and yellow. You can find that closing stock of April is written here in the month of May as opening stock, that is 60,000, and the closing stock of May, that is 69,000, it becomes opening stock of June. And once we have got all the informations like this, we can very simply find out the amount of purchases as balancing figure. So 84,000 minus 51,000, 33,000 rupees becomes the purchase for the month of April. For the month of May, 96,000 minus 60,000, it becomes 36,000. 99,000 minus 99,000 minus 69,000, 33,000 becomes this particular purchase of, or you can say the creditors of this particular month. So in this way, what we have done, we have learned how to calculate the amount of purchase as balancing figure. What we have done here, sales at cost, that is cost of goods sold plus closing stock minus opening stock, resultant value is our purchases. So after computing the purchases, our task is going to be very easy. Now we can very simply prepare the cash budget. We'll start with the cash balance for the opening balance in the month of April. Question reports opening balance of 7,500. We'll be adding receipt, that is cash sales and collection from debtors. Cash sale is rupees 16,000 as per the condition of the question. Collection from debtors is 30,000, which is given as the opening balance. When we aggregated it became 53,500. And then we'll be showing all the payments. Now for the payment for creditors, will go as per the condition of the question. Creditors are supposed to be paid in the next month. So 14,000 which was given there as opening balance, that is going to be shown here as payment, that is payment to creditors 14,000. Fixed cost, I told you it was 5,000 rupees, out of which 2,000 rupees was depreciation. So we have taken net amount of 3,000, which is common for all 3 months, April, May and June. Sales commission is given 5% on sales, and that is paid in subsequent month. So for the first month, whatever the opening balance is given, the same we have written here 3,500. For subsequent month, that is in the month of May, we'll be taking the corresponding sales of April. On that we'll calculate 5% and that amount becomes 2,000. In the month of June, we'll take the corresponding sale of May, and on sale of May we'll be computing 5%, it becomes 2250. In this way we have posted all the items of payments. After balancing the total inflows and total outflows, we get the closing balance. The closing balance for the first month becomes 33,000 rupees. For the month of May it becomes 37,000 rupees, and in the month of June 44,750. So in this question we have understood how to deal with with the component of calculation of amount of creditors. How to calculate, how to identify that what is my amount of creditor. What we have done here, we have taken sales, we have taken closing stock, but remember this is the only point where most of the students commit a mistake. What they do, they take sales at market value or sales at selling price. Don't take sales at selling price. What is the reason for that? Because you are going to calculate the amount of purchase. Opening stock is always computed, stock is always valued at cost or NRV, whichever is less. Here the cost we are going to take for the stock. So whether it is opening stock or it is closing stock, we will be taking the cost only. So when the opening stock is valued at cost, closing stock is valued at cost, we have to understand, my dear students, that sales is also supposed to be taken at cost. Because if you don't consider cost of goods sold, the profit margin will be included into your particular sales, which we are not supposed to do. So we'll be taking cost of goods sold, we'll be taking closing stock and then deduct opening stock, and suppose had there been some expenses, that also could have been added to this particular amount to arrive at purchase as balancing figure. And once the purchase is known to us, we can go as per the policy of the firm for payment to creditors. As per the creditors policy, you can decide that what should be the amount which we are going to pay to this particular firm. So we have understood how to deal with this particular computation of purchases. Now suppose we are going to deal with the situation where the collection term changes. Now what examiner does into a question of cash budget, or what are the different situations which a firm is going to face? Basically, if you look at the component of receipts and payments, in receipts you can have a different condition, in payments also you can have a different condition. If you talk about the receipt, there can be a condition that receipts are cash is going to be received in different installments. So let's have a look at another different type of problem where the cash collection is going to be different. So prepare a cash budget for Juhi Limited on the basis of following information for the 6 months commencing from April 2016. Suppose the firm is giving you the information like this, that cost and prices remain unchanged and the firm maintains a minimum cash balance of rupees 4 lakh, for which bank overdraft may be availed if required. So I am telling you point to point what we have to do, what is the implication of this particular point, and then we will be solving the numerical. Cost and price remain unchanged. Obviously it is short run, it is a short term forecasting technique, so cost and price is not going to change. And the firm is going to maintain a minimum cash balance of rupees 4 lakh. So just like first question, we have to understand that the minimum cash balance has to be rupees 4 lakh. It should not be less than that. If it is more than that, it is very good. And suppose if there is a shortage, the bank overdraft may be availed if required. So wherever the balance is less than 4 lakh rupees, we'll resort to this bank OD facility. Second information which question is reporting, cash sales are 25%. Very simple. Whatever sales is given, 25% we are going to record in the same month, that is cash sales. So for every month whatever sales is, we'll be writing cash sales. And the balance 75% will be credit sales. So it is clear that remaining 75% is going to be your credit sale. Now for this 75% question further informs that 60% of credit sales are collected in the month following the sales, which means suppose if your sale is occurring in the month of January, out of that total sales you have to take out first 75%, which is my credit sale. Once you have got the 75% of sale, now this becomes your credit sale. Out of this 75% of credit sales, you have to compute 60% of this, and this 60% you are going to receive in the subsequent month, that is here in this example will be February. So out of 75%, whatever the total amount is, out of that amount 60% you are going to receive in the subsequent month. Balance 30% and 10% in the 2 following months thereafter, which means out of this 75% of credit sales, the payment pattern is, the receipt pattern is that 60% you will be receiving in the next month, 30% in the subsequent month, and 10% in the next month, which means if it starts in the month of January, you will be receiving 60% in the month of February, 30% in the month of March, and 10% in the month of April. In this way, we'll be showing the collection from debtors. So this question is different in this way that collection from debtors is actually classified into 3 categories, where customers are paying in installment, and this is actually the reality. In practical life we come across such kind of situation. So we need to understand how to deal with this particular situation of cash collection when the cash collection is given for say cash and credit, and within credit we have different installments like 60, 30 and 10. So it is very simple to understand. Once we have understood, we can simply take up one amount. I always advise whatever amount you take, you post all items of this particular amount into different month, into subsequent months, so that there is no leftover. You don't leave any amount. So suppose if you have taken 1 lakh rupees, out of 1 lakh rupees 25,000 rupees is cash sale, you have posted. Remaining 75,000 rupees, 60% of this will come in February, 30% of this will come in the month of March, and remaining 10% in the month of April. So in this way we will be showing this particular collection from debtors. So this question is going to take comparatively greater time as compared to other questions where the collection policy is very simple, that cash is received in the same month 25% and 75% in subsequent month. The question says no bad debts are there, which means if there is no bad debts anticipated, there is no expense which is going to be accounted for bad debts. Sales forecasts are given like this. For the month of from the month of January to October, they are giving you the sales forecast for 10 months. At times students are getting confused why this sales forecast is given for 10 months. The reason is that you will be making use of these informations cause of this particular collection policy, which is saying that 60, 30 and 10. So you'll have to, if you are standing in the month of March, you'll have to go to the corresponding value of that 30% of this might be belonging to which amount. So in this way we'll be having the sales for 10 months. It is given here January, February, March, April, May, and for remaining 5 months also it is given. Question says gross profit margin is 20%, which means cost of goods sold is 80%. Quarterly interest payable is rupees 30,000. You have to mind here, my dear students, quarterly interest payable is rupees 30,000. Quarterly means 4 times in a year. If you take a calendar year, what is the quarter? The first quarter will be in the month of March, second will be in the month of June, then September, and then December. So whatever your cycle of budget is, you have to find out that which month is actually applicable for this particular amount of interest. So here will be going as per the given information. Rent payable is rupees 8,000 per month, for every month it is. Capital expenditure expected in September is rupees 1,20,000. This is the expenditure which belongs to the last month only, that is for the month of September. And the question is further giving you the anticipated purchase and wages for the year, and they are asking you to prepare a cash budget. So after we have discussed this particular these items of this particular question, we can understand how to deal with this particular problem of cash budget. I'll be solving this particular numerical in next lecture of mine, where you can understand the way we have to calculate. By the time you can take it as your homework, you can solve it on your own, and let's see whatever answer you got, whether it matches with mine or not. So in today's lecture of mine, let's recapitulate what we have discussed. We have actually understood how to practically implement the concept of cash forecasting in the form of cash budget, how to prepare a cash budget for a firm on monthly basis. We have not resorted to the weekly or annual basis, my dear students. The same is the methodology, the same is the modus operandi when you are going to prepare the cash budget on weekly basis, or even for that matter daily basis. There is no change into that particular way of dealing with it as far as the receipts and disbursement method is concerned. So in today's lecture, I tried to make you understand how to prepare a cash budget. I hope you must have understood and enjoyed today's lecture of mine. Thank you so much.